In today's video, I'm going to teach you how to trade gold in Oanda. First, let's get clear on what you're trading. On Oanda, gold is typically listed as XAUUSD, which simply means gold versus the US dollar. XAU represents gold, and USD is the US dollar. You're trading price movement through a contract for difference, not buying physical gold. That means you can speculate on price going up or down, but you don't take delivery of metal. Gold can move quickly, so keep risk in mind and consider practicing on a demo if you're new. Start by opening your trading platform. You can use Oanda's web platform called FX Trade or connect through MetaTrader 4 or MetaTrader 5. Whatever you choose, the process is similar. Next, find the gold symbol. In your platform search, type XAUUSD and add it to your watch list so it's easy to access. If you're on MT5 and don't see it, open the Market Watch window, right-click inside it, select Symbols, search for XAUUSD, and enable it so it appears for trading. Before placing any trade, take a moment to analyze. Check the overall trend on the 4-hour or daily charts to understand the bigger picture. Mark key support and resistance levels where price has reacted before. Then, look at US dollar news and interest rate updates. Gold often reacts strongly to shifts in interest rate expectations and to broad USD strength or weakness. Around major news events, volatility and spreads can widen, so plan your entries, exits, and risk accordingly. When you're ready, place your trade. Click Buy if you believe gold's price will rise, or sell if you think it will fall. Choose your position size, often called the lot size, based on your risk plan. Set a stop loss right away to define your maximum acceptable loss. Placing it beyond a logical technical level, below support for buys or above resistance for sells, can help. A take profit is optional. You can set a target in advance or manage the trade manually as price moves. Finally, click Place Trade to submit the order. Here's the core logic in simple terms. You buy when you expect price to go up, and you sell when you expect it to go down. It works just like Forex trading, but gold can be more volatile, so stay disciplined. Quick example. If gold is priced at 2,000 and you expect it to rise, you buy. If you expect it to drop, you sell. Your profit or loss will move as price changes relative to your entry. That's it. Find XAU, USD, analyze, manage risk, and execute with a clear plan. Stay patient, review your trades, and trade safely.